You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means we are back. It is Thursday. It is 1:30 p.m. Central. It is 2:30 p.m. Eastern. Do you know what's going on in the world of futures options? Well, let's find out together, shall we? It is time for TWIFO. This Week in Futures Options. My name, of course, Mark Longo from theoptionsinsider.com, as well as from the network that is growing all the time, including adding a new show just last week. Very relevant to TWIFO listeners. The Futures Rundown, now the latest addition to the network. Folks have been asking me for years, pulling me aside at events, writing into the network, when are you going to add a future show? When are you going to add a future show? We had TWIFO, and that covered us for a long time, but now the time has finally come, listeners. The Futures Rundown launched last week. Already 3 episodes in the can. You could have heard the first 2. The pro folks have the third now that will be hitting the feeds next week. So check it out. If you're just listening to TWIFO, yet another good incentive for you to upgrade and subscribe to the full network, because it's all there, nearly a dozen programs, including the latest edition, the Futures Rundown. And let's see who's joining us on the old CME hot seat today. I'm pleased to welcome back now a second timer, Mr. Kevin Green, the senior markets correspondent over there at the Schwab Network. Kevin, welcome back to TWIFO, sir.
Appreciate having me on, Mark. How's everything going?
Things are going well. Like I said, kind of busy. 17 and a half years in and still growing, Kevin. So pretty crazy. New shows hitting the network all the time, as it's time for us to hit the Movers and Shakers report.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers report.
All right, everybody, welcome to the Movers and Shakers, the portion of the show where we break down everything lighting it up to the light side and to the dark side over there at CME Group this week. And this is another week where we've had a lot of biases in our data over pretty much the last few years. It's like every week we're coming in here and it's 70, 80%, maybe 90% biased in one direction or the other. This week is another kind of equilateral week. We're seeing pretty close to 50-50 light side versus dark side on the screen. Now, I will say the largest percentage mover is to the light side. You might be able to guess which one that is. But outside of that, just raw numbers, we have roughly 50-50 on the board this week. So that means, Kevin, as our guest, you get the dubious honor. You get to choose. And you tell you what, why don't we let you just run with the whole thing? You get to choose where you start, light side or dark side, and then run it down for the folks. Think you can handle that? So you got a little bit of broadcast practice.
Yeah, we can try it out here. Let's start with the light side here because we're having green on the screen when it comes to the equity markets. Let's talk about some green on the screen in the commodity space. Here we have natural gas up 17.35%, followed up by palladium, which is attempting to try to complete a breakout here to the upside, up around 11.5% for the week. Platinum up around 5.2%. Technology sector up about 3.9%, a nice little bounce back there. And then class 3 milk up around 3.7%. Nice little squeeze there to the upside there. And then on the dark side, we have lean hogs down around 10.5% for the week. We have lumber down about 4%. Soybean oil down about 3.7%, followed up by corn down about 2.8%, and the energy sector down 2.5%, which is not surprising to say the least here, Mark.
I like it. I like your approach there. Going straight for the jugular, going for number one to start. You're not building the tension. You're not letting it grow. You're like straight for the jugular with number one. I like it. You know, that's why I like doing that, to see everyone has their own approach, and yours is to go straight for the top. I like it. All right, let's keep rolling here as we break down some vol out here as well, listeners. Remember, you can run pretty much all this data we're talking about on the show. You can run for yourselves, including the CVOL. Just type CME and CVOL into whatever browser you're rocking these days. That'll get you to the CVOL dashboard. Once you're there, set that high-low range to 1 week. It is this week in futures options, after all. That'll get you the entire range for vol for the week. Go to the ordered list. That'll sort you by change for the day. And then, bam, you're off to the races, just like we are right now. We'll start at the top of our list as well and work our way down. Top of our list this week in terms of the lightest move. And guess what, listeners? It's kind of a blood red week on the vol front. I know, hard to guess. Vol's getting killed across the board. The lightest vol getting killed today, at least, is the FX CVOL at a 7.05 as we're kicking off the show, off 0.17. And again, I think pretty much, all of them, without exception, are all pinning the needle to the bottom end of their weekly range out there this week. So every single one at the absolute bottom, they're nadir for the week. So bear that in mind. Vol kind of getting taken to the woodshed this week. FX vol at the top of our list, 7.05 at 0.17. The high for the week was 7.8. That's a big move in FX vol. We've seen a lot of action in FX of late. Obviously, a lot of talk about the dollar. Obviously, the yen carry trade meltdown really kind of sparked new interest in FX. If you listened to our futures rundown yesterday, you saw a lot of FX futures hitting that top 20 yesterday. US dollar loonie, dollar euro, dollar yen, all of them in the top 20. So hot action in the FX world these days. Maybe we'll hang out there today. We shall see. Right below it, we have the Treasury price vol. Remember, not a lot of price volatility in the Treasury complex. That's at a 6.15, off 0.31 today, and the high for the week was 7.51. So that's come in quite a bit as well. My goodness. Below it, we have the ag products. So the aggregate ag CVOL, 20.34, off 0.43 today, and the high for the week was 21.17. So again, just pinning the needle to the dark side for all of these. Below it, we have the aggregate metals CVOL, 16.71, off 0.45. The high was 17.92. So they're coming for metals vol this week as well. Commodities, the aggregate commodities CVOL, 31.92. That's off 1.35 just today. And on the week, the high was 33.31. So they're coming for the aggregate commodities vol as well. Is energy safe in this vol annihilation? The answer is no, listeners. The energy CVOL, 49.67, off 2.32 points just today. On the week, the high was 51.99. So they're coming for energy vol as well. And not to be forgotten, we have the Treasury yield vol, the highest raw number on our board at 113.9. That's off over 5.5 points today, 5.57. And the high was actually 139.22. So yield vol gets around, not messing around out there this week, off about 26 points. So they are coming for yield vol as well. All right, Kevin, that's a lot of table setting. We talked about vol moves. We talked about our movers and shakers to the light side and the dark side. Which of those is catching your eye? Where should we start this week?
Let's start with energy. I think that's been an interesting complex, to say the least, not only because of the move in oil, but also that move in natural gas, which has been obviously one of the leaders for it.
I think we can do that, listeners. Off to energy we go.
It's time to tap into the deep options well of black gold, Texas tea, nat gas, and more. It's time to talk energy.
All right, everybody, welcome to the wild world of energy. Go to that drop down, cmegroup.com/TWIFO. They may ask you to create an account with CME. It's free, takes 2 seconds. Then you get access to all of these super cool reports that we're using on the show. Once you're there, go into that asset class drop down, go down 3 slots to energy. Then go down another 3 slots in the product family. We're going to kick things off with our number one light side mover this week. Nat gas, as Kevin mentioned, 17.35%, number one to the upside, and it was number 2 last week to the upside, up 5.8%. So you're talking over 23% in the last couple of weeks. So banger couple of weeks. We're just speculating, what does the future hold for a nat gas out there? Apparently right now it's a whole heck of a lot of upside. We're at 236 in that front future right now, up about 9 cents or nearly 4%. Just this week, obviously, if you go back to the end of our show last week, that number a lot higher. And speaking of numbers, are pretty respectable on the volume front as well. 655,000 contracts on the tape. We'll break all that down in a second. But Kevin, obviously, nat gas is a big mover and shaker out there these days. What's catching your eye out there, sir?
Yeah, I would say for natural gas, there's 2 separate factors that are taking place. The first one is pretty much the obvious one, right? We have the seasonality effect taking place here. Natural gas will start to draw on inventories here, starting most likely in October, and that should last through March of next year. So I think there's probably a short covering event that's taking place, also some seasonality that is taking place there. And then we also have that hurricane that's out in the Gulf, which is taking offline some oil production as well as some gas production and potentially refineries. And it could have a little bit of a disruption when it comes to flow. So I think not only are we seeing that short covering, we also have the seasonality. It is trying to break out, but Mark, as you know, natural gas from a technical standpoint can destroy you. You also have to have the fundamental narrative. And right now the narrative is there. Let's see if it's going to be able to last, because it only takes 1 or 2 items to really change this thing on a dime, especially if we're looking at EIA inventories. If we start seeing a massive buildup in those over the next couple of weeks, it could really dampen price. But for now, for the winner seems to be the capstone for this trade right now.
They don't call it the Widowmaker for nothing, sir. We had a poll we did last week, which was kind of interesting. I'm looking here for the results. If I could, there we go. Yeah, last week on the show, we were hanging out a little bit below where we are right now, Kevin. We were at about 2.25 in that front future. And we had an interesting paper lighting up both the October 2.5 calls and the 2 puts. They were about equidistant in terms of volume out there. So we asked our audience, gun to your head, you had to buy one of those last week. 2.5 calls, 2 puts. Which one do you think won it, Kevin? And what would have been your trade? I guess in hindsight, it's easy to say the calls now, but what do you think our audience was down for a week ago?
They probably said puts. I would have said calls, though, and that's not because it's already moved. It's just because once you get to that 2 level, that 2 handle, it's very hard to really try to knock it down and to keep it lower than that. You're starting to get towards historical lows there. So probably a little bit cheaper premium on the upside. I would have probably took you.
Our audience actually went for the calls. I was surprised. I guess there's a little bit sexier to buy the upside than buy a 2 put, right? What are you going to do with the 2 put? But 2 calls. 2.5 calls, I should say, you could get a nice pop out there, and 60% going for the 2.5 calls. So looking good right now. Obviously not quite there yet, but you could have taken them off or something. So we'll count that as a winner out there this week. Let's see what the paper is this week. Is it lining up? Are folks loading up on calls yet again? The answer is no, listeners. The big dog, I said, we have about 655,000 contracts. 60% of the paper is going up in the October contract. It has about 13 days. So we'll hang our hat out there, listeners. Before I reveal the winner chicken dinner, the number 1 size contract out here, let's look at the vol really quickly. Like I said, they're coming for everything on the vol front this week. Nat gas, no exception. 56.60 about is where that October vol is trading right now, off about exactly 4 points on the week. If you go out to the skew, not a big evolution on the skew front week over week. Last week, the puts were 3.7% bid. This week, 3.6% bid, so no real change there. The calls last week, 2.5% cheap. This week, 2.6% cheap. So we have a modest investment skew, a modest equity skew, I would say, but nothing really dramatic. Let's look here. Let's scroll out a little bit. If you go out to March and actually February of next year, the puts are almost 7% discounted there, and the calls are about 11% bid in February next year. So we got a strong bid to the calls in February, which makes sense. Nat gas is a seasonal product at the end of the day, but right now and for the rest of the year, there's not a heck of a lot of juice from a skew perspective. That could obviously change on a dime, but right now looking kind of flat. And if you said it was going to be calls this week, listeners, nope, it was the October 2 puts. Nearly 70,000 of these, 69,000 and change, so over 10% of the volume in total in the product going up in these 2 puts in October. Folks had to have them this week, including today, 26,000 alone going up today. Now that's against an OI of 71,000, so they could be taking some off, but size paper today. 17,000 yesterday, also opening there. About 14,000 on Tuesday, 12,300 on Monday, opening both days there. So maybe folks looking for a little bit of retracement that could be aggressively overriding it as well. Given the fact that the skew is almost literally unched, I'm looking at probably a lot of back and forth paper on this strike, especially Tuesday. It was only modestly opening on Tuesday, so probably a little bit of a back and forth paper going on there. And then below it, if those are not out of the money enough for you listeners, how about the 1 3/4 puts also in October? And actually, I take it back. The 2.5 calls, if you want a little bit of upside, the 2.5 calls just slightly edging out the puts for the number 2 spot. 47, almost 48,000 of those versus 45,000 of the 1 3/4 puts. Again, today, the banger day. Today, a hot day, pun intended, in nat gas options, listeners. 17,600 of the 2.5 calls going up today. That's almost half of the OI, which is about 38,000. So interesting. And, we've had a little bit of a run here towards the 2.5 strike. Maybe some folks getting the heck out of Dodge. I could see that. Monday, about 14,000 going up, slightly opening there. 9,000 on Tuesday. Also, closing on Monday, closing on Tuesday as well. 7,500 today. Again, but you're talking small numbers of closing and opening. So I think it's truly a lot of back and forth, which makes sense. It's close to the at-the-money strike, so you expect some back and forth paper. And then today, just to see 17, almost 18,000 going up today. So a lot of action on the 2.5s today. And then right behind it, we have the 1 3/4 puts, 45,000 of those. Again, today, the big dog, 23,000. So we could have some vertical action going on with the 2 puts today. They line up pretty close. At least today they do. Today's action against an OI of 58,000. Interesting time. If you're going to do that, obviously you're probably going to be rolling up. That's the only thing that makes any sense there. 11,000 on Monday opening there, 6,000 on Tuesday opening, and then about 5,000 on Wednesday, slightly closing. So, Kevin, does that surprise you? We got the 2 puts and then the 2.5 calls and then the 1 3/4 puts in October kind of dominating the tape this week, sir.
Yeah, no, not at all. Not at all. I mean, you have a scenario where you have upside potential, upside skew there, but also if you have a rapid reversal, you could see natural gas collapse, right? And that's usually how that product works. It's not usually a gradual move to the downside. It's when we start seeing 4.5% days, 5% down days. So the positioning is actually not that surprising here. And once again, you get the right environment, weather event or something of that nature, these positions can burn rapidly and they could also squeeze rapidly to the upside too, right?
Since we're hanging out in energy, let's flip over, listeners, to the other one Kevin was talking about. The other one that's very much top of mind for a lot of you. It's not in our movers and shakers this week, even though the energy sector of the S&P is. So you can kind of look at that as a bit of a WTI surrogate, and they're certainly coming for energy aggregate vol on the CVOL. So let's go look at WTI, listeners. 69 even. The question we've been grappling with for the last couple of weeks is, whither WTI? Where's crude oil headed? And we had Carly Gunner on the show not too long ago. We were hanging out not that far from this level at the time, and she said if we dip much lower, maybe back below 66, then she was kind of really going to be in lookout below mode for WTI. As we're coming into the show today, we're seeing a little bit of a rally, up about 2%, or about 1.36 points, hanging out about exactly 69. So there was some worry. We were talking yesterday with our buddy, Mr. Dan Gramza, out there as well on the futures rundown. He was saying the same thing. These next couple of days are really going to be critical if we can see a little bit of a bounce or if we're going to see a bit of a sell-off. And in terms of action, it was an action-packed week. So it may not have been in our movers and shakers from an underlying movement perspective, but from a volume perspective, WTI would certainly be in there. 800,000. That's close to double what we would expect on a normal week, somewhere around 450. So folks lighting it up out here in WTI. Kevin, you said you wanted to talk crude oil as well this week. It's been a hot one, I'm sure, for you folks over there at Schwab. A lot of interest in crude. What's catching your eye out there, sir?
Yeah, obviously the price action moving to the downside, as well as the amount of short positioning from managed money. Now, if you kind of aggregate up not only just crude oil itself, that contract, but Brent, heating oil, also gasoline, to kind of aggregate that all up. It's one of the more historic short positions that we've seen from managed money in a very long time. So one thing to just kind of note, obviously we've seen a lot of weakness when it comes to the fundamental data, especially out of China. I think the market's starting to realize that a little bit more and starting to actually price that in. And then we might also have some near-term demand risk here in the United States, as well as in the European Union. So I think the market right now is kind of selling first, asking questions later, and they really want the fundamental data to prove that crude should actually be at, let's say, $75 or even $80 at this point. But I think it's the China story, unfortunately. We have some mixed data here in the United States. Maybe it's a short selling event that's taking place, but we just need to have that good fundamental data, that catalyst, that PMI data coming out of China, the inflationary data coming out of China that goes in the right direction. And that is going to be enough to probably set these crude bulls back on track. But right now, you get a little bit nervous, and Carly, she's a phenomenal analyst, and I'm right there with her. I mean, for me, it was around $68. Breakdown below that really is a little bit concerning, especially being away from that 200-week moving average for so long, because if we are not able to hold these levels, you could actually see a rapid spike or move to the downside. You're talking about, $50, $55, and that's something that you just do not want to do, and that does not also align with the soft landing narrative, as production levels for the most part have not gone. It hasn't been extreme to the upside. It's been very steady. All right. So that's kind of where we're at with crude. I think over the next 2 weeks, we're going to really find out if this is just a blip on the radar, or if there's something that's going to traverse itself across multiple asset classes.
Yeah, I was going to save this for the futures options feedback segment, but I will cheat and bump it up now. This was a comment from one of our listeners, Ilona M. They said, oil may have bottomed if it can hold this RSI weekly support line. And I recommend you follow us, listeners. You can see this interesting chart that they tweeted out. They tweet out USO, but you can make the same analysis for WTI listeners. It says, oil may have bottomed if it can hold this RSI weekly support line. Puts in parentheses, this RSA line is where oil broke out back in 2020. 2020, obviously a pivotal year for crude oil for many reasons. And it is now coming back to retest that same line. If it breaks below, then bad news for oil. But if it can hold, the worst may be over. So it sounds like he's lining up just like you are, Kevin, that if they can hold this level, then maybe the worst is behind us. But if not, then maybe look out below, Kevin.
Yeah, definitely. And it's also going to be dependent on OPEC, too. I mean, there was this whole notion that OPEC was going to bring production online, additional production online in October, and we saw a couple of news reports that also created a little bit of volatility. And then now it sounds like they're going to push that decision back by about another 2 months. But when you started seeing price levels around where they're at right now, and OPEC actually increasing production, if that's going to be the case down the road here, then you start to wonder the stability of a $70 a barrel oil, or even a $60 a barrel oil. I'm not sure if they want to take that type of action and collapse prices. But if they do want to try to take that action, then we have to also look at the shale production here in the United States, because margins will be squeezed. And actually, the 3-2-1 crack spread sitting at around $14.91. That just means that energy companies, especially when you're looking at the refiners, have seen their margins collapse. And so there might be an equity re-rating going on as well there. We'll probably see that in another couple of months. But we do need to have a recovery. And you kind of want to start seeing the recovery in the byproducts probably first, rather than crude oil. That's going to give you that sign that demand is holding up. Right now, especially if you're looking at heating oil or diesel, it doesn't seem to appear that that's the case.
It does seem like 60, 65 is a pivotal level for a lot of people. I remember the last time, years ago, when we really started plummeting in WTI. A lot of people were coming on the network. A lot of people were writing in saying, okay, 65, that's where I'm selling the puts. 60, that's where I'm selling the puts. This far and no farther. We're going to bounce off this. And of course, we know what happened. We blew through all of that, and it took a while to get back to 60. So that, a lot of people were wearing it there. But it'd be interesting to see, listeners, if this time it can hold this 65 to 60 level. Right now, that front future at about a 69 even, so looking pretty good out there. And I said a pretty active week on the options front, 805,000 contracts, 31% of that going up in the October contract that has 5 days to go. But we're not going to hang out there. We're going to go a little bit farther, actually, to where the number one most active contract is this week, listeners. We're going to go out to December. That's a whopping 64 days out. That's an eternity in this 0-day palooza, listeners, because that's where the big dog is going up this week. The future in December a little bit lower, 67.5, just to give you some context. Vol out there in December, 32 and about a third, off about 3/4 of a point. So off, but off slightly. Skew-wise, we're seeing that bid, I should say, continuing to build in the put wing. It was 8.5% bid last week. This week, growing to 10.5%. So read into that what you will, listeners. In fact, looking across the skew here, across the term structure, we're seeing the bid creeping up in all of these puts, which could be reflecting some of that fear that our chartist and Kevin and Carly and others were saying, that if it does continue to move to the downside, it could be a bit of a lookout below. Doesn't seem like there's a lot of interest in the calls. That's also interesting as well. The puts, I said, 10.1% bid this week. The calls last week, 5.9% cheap. Getting cheaper this week, 6.8% cheap out here. So that's kind of interesting given everything we're seeing out here. Maybe showing that, at least for right now, the bias, the concern on the options market side is to the downside. And that also explains our number one most active contract out here in WTI this week. If you can't guess by now, listeners, it's the D60 puts, lighting it up 30,000 times. The big dog was actually Tuesday, 12,600. Looks like a lot of back and forth paper that day. 8,100 on Monday, mostly opening there. 6,800 contracts today against an OI of 40,000, and 3,000 on Wednesday as well. So slightly opening there. So a lot of back and forth on these 60 puts. But again, given everything we're saying, maybe not surprising that we're seeing 60 puts in December leading the dance. Kevin, does that surprise you? 60 puts hot out of the gate this week in December in WTI?
No, not at all. And actually, that would be close to a break-even level for a lot of producers out there as well. So it's not only, when we look at these options, not only just retail or institutional investors, it's also the producers that want to be able to lock in certain prices. And so if you're a small player, especially if you're in Eagle Ford or even the Permian, and you're running a small shop, trying to hedge at that $60 level will probably help you, because they don't have as much price flexibility or operating flexibility than you could say maybe some of those larger integrateds where their break-even levels are $35, $30 or what have you. So not surprising. That could also be a little bit of a gamma wall too, where we start seeing buyers actually stepping in at 60 if it does occur, if the exposure continues to be outsized, especially on the put side.
A gamma wall. I like it. I like that, sir. I may have to borrow that. Let's keep rolling here really quickly. Let's go out to some of the near-dated stuff. I said the October contract is where the lion's share, 31.2% of the action. That's where we find our number two most active contract. Also on the put side, but not quite as dire. The 65 puts going up 19,000 times this week. Again, these expire in 5 days. So looks like folks mostly bailing on these this week. Closing pretty much every day. The big days are Tuesday and Wednesday, about 5,000 each. Actually, today, a little over that, 6,100 against an OI of 15,500 and about 3,000 on Monday. So looks like folks mostly getting the heck out of Dodge on these puts, which again makes some sense. If you're long these, we're rallying away. Only 5 days to go. You want to get what you can out of there. Interestingly enough, that put bid still persists out there. In fact, getting a little bit stronger. So that might indicate some folks were net buying on some of these puts out here, which is kind of interesting. 60 puts also, folks bailing on those to the tune of about 15,000 this week as well in October. So a lot of put closing, but the put wing remains bid with just 5 days to go, which is fascinating. Speaking of fascinating, there's a lot of other fascinating products on the docket. Mr. Kevin, where should we head next, sir?
Let's head over to Ags, since we had the WASDE report today. So a little bit of volatility there.
All right, to the world of Ags we go.
It's time to get our hands dirty exploring the latest options, trades, and trends in corn, wheat, soybeans, and more. It's time to talk Ags.
All right, listeners, welcome to the wild world of Ags. Go into that drop-down alpha order list, so go right to the top, agriculture. Then from there, probably going to hang out in grains and oil seeds. And then from there, it's kind of an embarrassment of riches. We do have corn number 4 on our dark side this week, off 2.8%. We have soybean oil number 3, off 3.7%. In fact, it's all ags of the dark side. Number 2, lumber. That's, of course, in the softs, listeners, off 4.08%. And the number 1 to the dark side, lean hogs, off 10.5%. So a lot of ags in our dark side. But Kevin, catch our listeners up. Tell them about the report you were talking about. What's catching your eye in the ags today?
Well, the WASDE report basically updated us as to the progress for current harvest for certain products, as well as the expected ending crops for this year. I would say marginally, we did see a little bit of a bit of recovery when it came to corn. We also saw a little bit of recovery when it came to soybeans. Not so much when it came to wheat production, as well as ending stocks for the most part stayed unchanged. But we're starting to get towards that time of the year where harvesting will take place in the next month and a half. And so now it's going to be the fact that can we match the estimates that we have out there, which the estimates are actually very aggressive. There's a lot of ending supplies that are expected there, especially when you're looking at soybeans and corn. We know that stockpiles are already pretty much filled to the rafters. We also know that there's a lot of competition between us and South America, specifically Brazil and Argentina. So we need to have, if you are a bear or for soybeans, you want to have a really good harvest, we need to have really good weather over the next, let's say, 3 weeks to 4 weeks. And that would actually then kind of solidify those soybeans, and that would actually be bearish for the most part for prices. And if you're a bull, you would actually like to see some maybe adverse weather events, maybe a re-escalation in the Black Sea to impact grain shipments coming out of the Ukraine and the whole Russia conflict. But for right now, the USDA didn't really shock the street when it came to their expectations. I would say more marginal on the edges, and really trying to readjust their international outlook when it comes to production of not only corn, but also soybeans, which is the two major ags that we really kind of focus on here.
You mentioned the big dog, corn. Let's hit it. Right now, listeners, 406.5 on that front future, up slightly on the week. So obviously, a lot of that downside came since our show at the end of last week. In terms of action, about what we expect, corn usually puts up around 400,000. That's pretty much what it is right now, 402,000 contracts on the tape. So not blowing the doors off from a volume perspective, coming in right in line. 31% of that going up in the Dees contract that has 71 days to go. But we're not hanging out there, listeners. We're going to go to the number one, the big dog, which is the par puts going away in about 8 days in corn, 400 puts. So some near-dated paper. Ags are always fascinating. They're always usually pretty far dated or very near dated, and we're seeing the latter out there this week. So let's hang out there. The OC contract, 8 days to go. What is the vol, you might be asking, in corn? In this near dated contract, right about a 22.20, up about a third. If you go out to where 31% of the paper is going up in Dees, that vol is at 17 and a third. So you're talking nearly a 5-point chasm between the October and the December contracts out there. It's a wide gulf on the vol front. Skew-wise, the puts 2.1% bid in October last week. This week, 1% discounted, so swinging slightly the other way. The calls, 4.1% cheap last week. This week, 2% bid. And going out to December, the puts were an astonishing 18.3% discounted last week. That's, given the fact that your vol is already sub 20, and now you're taking 18% again off the top. They were really crushing those puts last week. This week, that's mostly gone. 2.4% cheaper the puts this week. The call is 1.9% bid in December. This week, about 2.1. So not a lot of action in the calls. It's those puts, though. I think the technical term is crazy town. Let's go out to the par puts, though. 400 puts going out in about 8 days, going up 33,000 times. So a good chunk of the paper is in these par puts this week, including 21,000 today. 21,200. So that's your report paper right there, Kevin, against 16,500. That's the OI. So clearly opening paper on the 400 puts. Also makes sense that 6.5 handles out of the money. So it's a pretty near at the money put at this point. 10,500 yesterday, and then not much the rest of the week, about 1,000 on Tuesday and just a couple of hundred on Monday. So Kevin, folks piling into the 400 puts with about 8 days to go. Does that surprise you, or is that pretty much what you expected given what we saw coming out of the report?
No, that's exactly probably what you should expect here. When you're kind of looking at the outlook and that guidance moving forward, they did actually increase the forecast when it came to corn, right? They increased by about 15.2 billion bushels, but they did also reduce the ending stock by around 16 million bushels. Now, we also are seeing a little bit of a bright spot when it comes to export demand, especially for China. That is because of the lower dollar, and that's also because inventory levels, when you're looking at Brazil and Argentina for some of these products, are starting to level out or be drawn down here. So we have a little bit more of an advantage because of pricing, more at parity because of that weaker dollar, quality of crops a little bit better, and then just sourcing in general. So I think the market right now is just concerned because the growing season has been so great, and the demand looks like it wasn't as bad.
We know we got a few minutes left, Kevin. I know you got to hop in a little bit. You got your own show you got to hop on in a little bit, so I can respect that. But before we go, we've got to get a little bit of the old futures options feedback in.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's Mixlr.com.
All right, everybody, welcome to your feedback. We already hit on a couple already. We talked about your feedback on crude oil. We talked about your voting on the Nat Gas flash poll we did with Mr. Russell Rhodes on the show last week. But we got our actual question of the week to pay off right now. And Kevin, I want to get your thoughts on this because it is a timely one. We're asking, the question everyone's asking right now in the markets when it comes to the equity space and, of course, rates. Everyone's debating, what's the Fed going to do next week? The expectation, of course, is for a quarter of a point. In fact, if you look at the Fed Watch right before the show, it was pricing in exactly 75% probability of a 25 basis point cut and a 25% probability of a 50 basis point cut. And that's it. They're not pricing anything else in, which is kind of fascinating. But we asked you, if the Fed does what's expected, cuts a quarter of a point, what happens to the markets? Are we going to see a strong rally? People are excited. They finally get the rate cut they've been waiting for. Is it not enough of a rate cut, so we see a big sell-off? Is it a bit of a, shrug your shoulders, not much going on, or something else? Kevin, what is your take? And then more importantly, which way do you think our audience is going?
Oh, man. All right. So I would say 25 basis points will be the cut for next week. We also have to be mindful, too. We're going to get the summary of economic projections. So we could actually have some volatility before Powell even speaks, as we kind of go through some of the numbers of their expectations for the remainder of this year, as well as for next year. And I think the big highlight there is going to be the unemployment rate. How is the market going to respond? I'm not sure. I mean, we're seeing a nice little rebound when it comes to equities, but generally when we start seeing these cuts, we also see economic weakness, and I'm not sure how conducive that is going to be for equities. I would say probably maybe a push to the upside post that report, maybe for a day or a couple of days. Then we're going to be seeing some labor market statistics coming in again, and that's probably when we're going to see volatility in this market. That's where I'm at. I would believe that the viewers and those that voted are also assuming 25 basis points, as well as maybe a buying opportunity, I would assume.
Let's find out, shall we? And right now, 41.7% are saying it's going to be a shrug your shoulders. They're not expecting much at all. 31.3% say it's going to be a big sell-off, not enough of a cut. 22.9% expect a strong rally. And only 4.2% saying other right now, Kevin. So there we go. They're kind of expecting a big nothing burger, Kevin, which is interesting. That music, of course, means we are out of time for this week. But before we go, Kevin, if folks want to check out all the stuff you have cooking, where should they go? What should they do?
Yeah, you can follow me on X or Twitter at KG Bull and Bear. I'm on the Schwab network literally all day, every day, so you can check me out there. And you can also check me out on LinkedIn. So, Mark, I always do appreciate being on. I know it's my second time, but always looking forward to doing it. And you guys put out really great content that I know a lot of traders really do enjoy. So thank you so much.
Well, I appreciate it, sir. 17 and a half years and still growing, so must be doing something right? So check them out, listeners. You know where to find them. The Schwab network, pretty easy to find. You know what else is easy to find is the TWIFO reports that we're talking about all throughout the show. CMEgroup.com/TWIFO, TWIFO, the place to go to kick the tires and light the fires. You can find the Fed Watch there. You can find the CVOL there. You can find all the fun stuff that we're talking about throughout the show while you're there, listeners. That is going to do it for us on the network today. Back again tomorrow, noon Central, talking a little bit of vol. We'll have Mr. Dr. Vix. Who else will join us? I guess you got to find out. Tune into the show tomorrow or after the fact, of course, on your podcast device of choice. And then one final time for the week, we come back after Vol Views exclusively for our pro folks to talk about all the weird, wild trades we have in our own trading accounts, as well as what we're seeing out there in the unusual activity screens. You want to check that out for yourselves. Only one place to go. TheOptionsInsider.com/pro is the place to go. Then we're off for the weekend. Give my voice a little bit of a rest. I'm heading down to Florida next week for the STA conference, so that should be kind of fun. See what's going on at the intersection of equities and options. Should be fun. A little bit of crypto usually sprinkled in there as well. So I'll be BBing in from there next week. So that should be a fun time. And we'll see you back here next Thursday, another episode of This Week in Futures Options. Stay safe out there, everybody.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.